You're probably here to find out what happened with BYND this week and why I've raised my price target on it. To the best of my ability, I'll try to run down what fundamentally changed about Beyond over the past few days and why it is a completely different company. First things first, I am not a capybara. As you know, I've purchased 4% of Beyond's float ahead of the dilution, issuing a price target of $3 per share, which we've now blown past, trading at roughly $4.50 per share after hours. As it is the main short-term driver, let's try to start with the technicals first of what is going on. After blowing through all resistance levels and remaining pockets of selling pressure from previous trading days, there is now no predefined levels of selling pressure before at least $6 per share, which it was trading at a long time ago. FINRA data shows there were today still more shorts than long positions. In fact, 57% of today's volume was still sold short, meaning that despite this ongoing squeeze, the short pressure as a percentage of float is still not being affected, according to Fintel. In fact, it is actually even rising. There are even more shorts now than there were before, if we believe this data, which seems actually pretty accurate depending on the dynamics of what is going on. It seems that the old shorts were in effect buying back from people who are borrowing stocks again from shareholders and selling themselves this short to the previous shorts. And essentially, the net short position isn't changing at all so far. And a significant number of the float is still short and still needs to be bought back in the market as of today. Another important to watch from this movement that saw over 2 billion shares traded today on Tuesday, which makes it the most traded stock on the exchange for the past 3 days, actually. It also equates to about 30 times the company's float changing hands in one day. As a part of this, what's important to understand is the rotation from previous holders, 80% of which were recipients of new shares through the conversion of the convertible note, to retail investors. In fact, it seems that former bondholders who received those shares are now calling back the shares that they had loaned at very high premiums, which seems to be accelerating the timeline in which people shorting the stock are having to cover. This theory is supported by shares available to borrow dropping to zero today, down from just 10 million, whilst at the same time, costs to borrow fell to 45% per year, meaning there is no outgoing demand to loan out shares from those institutions. Retail, which is growing as a percentage of the shareholder base day by day, is more used to selling options instead of lending out their stocks. Plus, they're often using platforms that don't even offer that option or pay very little fees compared to what are the actual costs to borrow. And this is further supported by the fact that option volumes have skyrocketed today, with 5 times more options being traded on Tuesday than had traded on Monday. Near $200 million in premiums for put and call options have been purchased since the start of this rally over the past 3 days, which is about 20% of the market cap of the company. So it's extremely significant. And all of this means that open short positions will need to buy back shares in the market, since there's no interest from lenders to cover their shorts and extend them. And they'll have to do that in a market where sellers are incentivized to hold on to shares, as the premium they're collecting by issuing even weekly options is around 10% of their share price. By the way, looking at the options market with expiries at the end of this week and next week, you can see that call option traders are already pricing in the stock between $5.5 and $6.5 over the course of the next few days. These technical factors create an environment for those that went through the data with very little interest to sell and a rapidly growing share price, which is driving more and more shorts covering. However, the fundamental value behind the company's repositioning is perhaps more important, as it is, in effect, what has started all of this beyond to infinity and beyond movement and this technical surge, the actual fundamental changes behind the business. If you look back to 2022 and 2023, before a bankruptcy risk came into the picture for Beyond Meat, Beyond was trading for the longest time at an enterprise value of around $2.5 billion. Yet, back in those days, the business was doing arguably worse than it is today. Gross profit margins were negative 5% versus positive 12% today. Sales and administrative expenses were 230 million per year compared to 120 million today. EBITDA was negative 300 million compared to negative 120 million today. It was the bankruptcy risk that has sent the shares down 50% 2 years in a row, not the deterioration of the business, as is often reported. And the solution to this main problem, as we all know, came from the convertible note cancellation, which, as a reminder, involved convertible note holders of $1.15 billion of convertible debt to cancel 900 million worth of debt and to issue new convertible notes for $200 million that can actually be converted into equity down the line by Beyond. If we take the valuation at which this business was trading before the bankruptcy risk, you end up at $2.5 billion, which is roughly $6 per share at the current trade count. This is where the price target came from that I said after the initial target was hit in 3 days instead of 3 weeks. However, the fundamentals of the business are changing. And you can argue that today the business of Beyond Meat is significantly better and more optimistic towards the future than it was before. First of all, Beyond is switching its products to be healthier and more bio-oriented through lots of product development. This included the ingredient list being simplified, a switch to avocado oil as a base for their products. Saturated fat went down 60%, sodium went down 20%, taste and texture improved. And the highly processed nature of Beyond Meat's products was also one of the biggest arguments against critics of the actual products and consumers as to why they were not essentially making it a part of their everyday diet. At the same time, they addressed the second point, although less impactfully, the price point at which Beyond Meat sells, which has gone now slightly down with their Walmart expansion, in which they've introduced a value pack with 6 Beyond Burgers in one pack and at a lower price, which was the second argument, was price accessibility in buying those products. And in addressing both of the main arguments, they've made the product significantly better. And at the same time, they are making very significant efforts to fix the distribution channels of Beyond Meat in a accretive way, which wasn't happening before. If you look at their production costs, they went down over the past year and a half, and this is why the gross profit margin expanded from -5% to +12%. At the same time, the Walmart expansion to over 2,000 stores, which was announced today, shows that the Beyond brand is still incredibly strong and resonates with consumers, as no company or manufacturer without a brand is able to get those deals. And the increased distribution to Walmart stores should impact directly revenues in Q4 and Q1, and also directly improve the bottom line of the business. Another overlooked part of their announcement from yesterday, involving their new mycelium steak that they released, was the Beyond test kitchens that they launched. And that product was a part of that launch. First of all, it creates a very quick feedback loop for them in developing and testing new products, and not essentially rolling them out nationwide until they actually understand the demand behind them, which lowers risks of inventory that doesn't sell through. And Beyond currently has over $100 million in inventory. It also allows the company to make better products, which is what we're seeing with their move to healthier options. But more importantly, it is building a direct-to-consumer channel, which Beyond hasn't had in years, except an experiment that they ran in 2022. It matters not only because they build a direct relationship with the client, it matters more as to the revenue that they're getting per unit sold. In wholesale, typically the discount is around 50% of retail to wholesale. And since Beyond is selling at those same prices, that extra 50% per unit sold is translating directly into revenue, but more importantly, directly into gross profit, meaning the margin that they make on direct to consumer is significantly higher. Typically, companies don't resort to direct to consumers because they don't have the infrastructure or the ability to do it, but Beyond actually owns its production facilities, warehouses, and has a logistics system that was developed in 2024 by Palantir. So it can address all of those issues and maybe first not at scale, but grow this direct to consumer business. All of these fundamental changes, if they continue to go in the right direction over the next few quarters, for the first time in a very long time, they provide a clear argument how Beyond Meat can reach EBITDA profitability, which it hasn't had in years, and perhaps the last time it has had those moments where you could see and project it out was towards the early years of its IPO. At that time, of course, as we all remember, the business was trading at roughly 15 times what it is today. In short, if you are to remember anything and only the key themes of this, you have short-term technical events that are pushing this up, and in the immediate term could greatly outperform this price target of $6 that I said in the beginning. Long term, you have good things happening product-wise, margin-wise, that slowly but steadily are improving the net margins of the business, even though they're coming from a long way back, you can see the improvements, not on a revenue scale for now, but on an efficiency side, which is perhaps the biggest criticism that BYND received before. And aside from that, the debt cancellation, fundamental improvements to the business, and most importantly, the balance sheet that can restore the value of this business to $2.5 billion in enterprise value have already happened, which is why this $6 per share floor is likely to hold, because this valuation has historically held for years for a business that was essentially stagnant and doing much less towards growth than the Beyond Meat we're dealing with today. To finish, I wanted to say that the scale of the movement to infinity and beyond that has happened over the past several days was impossible to predict by anyone, including me. And should this continue to press on, it might greatly increase all of the figures mentioned in this video. As the scale of the volume of trades and the scale of the engagement that is not dying down, but actually accelerating, is something that is quite unique, rare, and perhaps indeed hasn't happened since the early GameStop days. To all of those that have supported my initial thesis when the stock was trading at 50 cents, I wanted to say thank you for instigating a movement that is changing many people's lives based on my DMs, and on their behalf, and all of the messages that I've been receiving of people saying that they've made 10, 20, $50,000 in life-changing money for them. All of this couldn't have been possible without all of the community from Reddit, X, and elsewhere that has banned around these investment theses. And on behalf of all those people, I did want to thank you, and I'm sure they'll be glad to that you know how much it meant to them. I also wanted to encourage those of you that are up 5x, 8x, or even 10x on their positions on Beyond to remember to be careful. Caution is required whenever you're investing. And if you are at those stratospheric levels of profit on one investment within a week, and those investments, more importantly, represent a significant amount of your perhaps net worth or capital liquidity, it won't make any difference to the scale of the movement that is happening now if you decide to trim your positions by 5, 10, 15%, exercise caution, and protect your downside and make it into a risk-free investment that will allow you to hold on to it until it runs, which objectively we have at this point no concrete way of understanding what will be the top of this rally, which is rapidly unfolding. Thank you all for listening this long to this video and to why I like this stock.